Bree,
And
some of the speakers are jumping on. Do we want to let them in?
Yeah, let any speaker in.
Okay. Chris.
And then let's let all the speakers kind of know the situation on, turnout. And then they should all know Crystal attended for Sheel. I mean, they'll figure it out. They're professionals.
there he is. You on mute. Classic.
I was gonna put it on my cat.
Okay, I just let Kat in.
Yeah.
Okay.
Hi guys.
Good morning or good afternoon, I guess, for Kat, huh?
Yeah.
Thanks for joining. We have over 100 RSVPs, so we're letting the speakers in and then we'll let everyone in.
Sounds great.
Okay.
Okay, Maddie's here. Okay, should we when do you guys want to start the admit all button? It's 9 o'clock. You want to go ahead and start admitting everyone?
Yep.
All right, Ruben, do your thing.
Hello, everyone. We are going to let the room settle a little bit for a couple of minutes, and then we'll start introducing our panelists. So just hang in tight. Thank you. Hello, everyone. We're just letting the room settle for a little bit. We will start in a minute or so. Thank you. Hello, everyone. Welcome to the 2021 Fintech Roundtable. I'm your host and moderator, Ruben Austin from Burkland Associates. We are a startup consultancy in the financial space. We help with CFO services, bookkeeping, accounting, and tax. I real quick want to introduce our panelists as well as our other sponsors. I will have Morgan say 2 words on Vouch, who's one of our sponsors, and then we will go through our panelists.
Hi, everyone. Good morning. I'm Vouch's Community and Events Manager. We're co-sponsoring the event with Burkland, and I will actually pass the torch to Travis to kick off the speakers. He's our co-founder, and we're super excited to be here.
Awesome. Thanks, Morgan, Ruben, and the Burkland team. Really excited to be here today. I'm Travis, co-founder of Vouch. We do business insurance for the technology industry. So we make it super simple to get everything from E&O, D&O, cyber, less than 10 minutes, active same day. But I'll keep it short and hand it back to Ruben. Excited to dig in today.
Thanks so much. Thomas, would love for you to introduce yourself.
Yeah, hey everybody. Thomas Rush. I work at Consensys Mesh. We're the investment arm of Consensys, and we're primarily a blockchain software development firm and also an early stage investor in both equity in startups themselves, as well as a number of digital assets. And so at that firm, I serve as head of the investment platform, working on the investment team, making sure that we're making the right decisions in terms of return profiles, as well as some operational elements.
Thank you so much. Chris Lavery from Avalanche.
Hi, I'm Chris Lavery, CFO at Ava Labs, working on the Avalanche protocol. I was actually, Ava Labs was my first client I had when I was a fractional CFO at Burkland. So I decided to join them after they had their token sale. So Ava Labs is building Avalanche protocol. It's a first layer protocol for launching decentralized applications and enterprise blockchain deployments. Our native token is a Vouch, and we, this week we just built a bridge that actually connects Avalanche with Ethereum. We just launched it this week.
Excellent, thank you. Sheel, you're up next.
Hey guys, I'm Sheel. I'm a general partner of a fintech-focused seed fund called Better Tomorrow Ventures. We are a $75 million fund. We just lead pre-seed and seed stage investments in fintech, sort of across the board, although we don't do crypto. And prior to that, I was an entrepreneur a couple of times.
Excellent, thank you. And Kat from Core.
Hi, thanks for having me. So great to see everyone today. So many friendly faces in the audience. I'm the managing partner of Core Innovation Capital. Our whole philosophy is mercenary returns through missionary investments in financial services and insurance technology. So kind of like Sheel, believe in doing well and doing good at the same time, and believe we actually make more money when we bring true value to an end customer. But investing in anything modernizing financial services and insurance infrastructure, and also direct to consumer companies that help with affordability and accessibility in financial services and insurance. We will do crypto as well. And most of our initial checks are in the seed or Series A, usually leading or co-leading with up to $7 million.
Thank you so much. I would actually like Edwin to also say a word as well, since he will be joining one of the breakout rooms later. Your behalf.
Hi guys, Edwin here. Also on the Core team, I work with Kat. So I'll be taking over for the last portion on the breakout room. She covered most of what we do, but I'm a VP on the Core investment team. Nice to meet you guys.
Thanks so much. And last but not least, Trevor Taniflum from FS Vector.
Thanks. Thanks very much, Drew. Very nice to be here. How's it going, everyone? My name is Trevor Taniflum. I'm a principal at FS Vector, which is a fintech strategic advisory firm. That's a little bit different from the usual advisory model in that we don't offer sort of modular project-oriented advisory services. And we really seek to build long-term relationships with clients which allows us to kind of work with them and help them solve business, compliance, product operational issues as they scale and grow. By way of personal background, I'm a lawyer by training, worked at both CFTC and FINRA. So I've got a little bit of a background in both securities and derivatives, and then bounced around financial services, consulting, mostly in banking. So very excited to be here and looking forward to chatting with everyone.
Excellent. So let's dive right into some questions for everyone. Let's start off a little bit lighter. I would like to find out a little bit more about the most recent fun portfolio company that you guys done, either investment or projects that you guys worked on, just to lighten up the room and have a quick, easy intro. And then I think we can go in a little bit more in-depth questions. I think, Trevor, since you already spoke last, let's start with you. And then we move on.
Yeah, so we work with a couple hundred fintech companies that we insure, and when I think about the ones that are most interesting, it's those that are not just taking friction out of an existing process, but leveraging that to build entirely new products and experiences. And so Pipe is probably the first one that comes to mind, and I think early days, remains to be seen of how that plays out and the changes kind of in the financing dynamics. But I think it's a great example of a company that's bringing together innovations in technology and capital markets to deliver fundamentally new financial products.
Awesome, thank you. Now I said Trevor, but now we're actually going to go to Trevor Taniflum. So we mix it up a little bit. But Trevor, as I mentioned, would love to hear a little bit more on what you've seen recently and what interesting projects you've been working on. So yeah, hit it off.
Yeah, in terms of some of the more interesting things, we've got a few clients working on sort of this concept of self-driving bank accounts. I think kind of piggybacking off what Travis said, I think innovation in the neobank space has been a little bit slow. They've long been accused of basically offering the same traditional banking services, except in a cool app with lots of fun colors. So I think the concept of autonomous finance is something that is a really exciting space for me.
Excellent. Let's see, who wants to go next? Let's go with Kat and Edwin. You guys always work on fun stuff, as I know.
Yeah, most of the recent stuff, actually the stuff we did in last year, we can't even announce because everything's in stealth lately. So I wish I could talk about some of it, but I promise you it's interesting. But the stuff that I can talk about that I think is important and actually has been publicly announced is really looking for private market solutions to public problems. So, we recently made an announcement that we had invested in Pando pooling. And for us, we think it's income pooling. So pretty much average pool has 6 people. And when you make over $1 million up to $100 million, you throw about 10% of money into the pool. And so it's great. You can share on the upside. It's kind of like how, Sheel and I can invest in each other's funds and we get the upside. And so if one of us gets really lucky, great, we all benefit. And then for some reason, if one of us has a really tough fund year, we can, it's almost like insurance that at least we'll still get some compensation. I think broadly, we think about that as like a privatized Social Security if it hit all Americans. We're investing in a company called PadSplit, which we think about as privatized affordable housing. And then Health Sherpa, which to us is like a private healthcare.gov. So I think, as far as general themes, as we can see, especially in the last a couple months, if it hasn't been blatantly obvious, there's a lot of economic inequality, and I don't think that the government's going to be the best to solve it. So we've been really excited about these private companies taking really long-term scalable views to public challenges.
Wow, that was interesting. Let's go to Sheel.
Sheel, try to follow that up.
Yeah, that was really good, Kat. Hard to beat that. That was a fantastic answer. I'd say so similarly, we've done a few recently that we can't announce yet. For us, actually, lately, we've done a bunch of stuff internationally. And what we're finding is a lot of the models that have been working really well here have to be sort of, changed a little bit in different markets, but there's a lot of exciting stuff happening internationally that we've been investing in. Our last deal that we announced is a company called Vouch. It's a fleet payments company. There are a couple of large players in this space, WEX and FleetCor. They're like $10 and $20 billion companies. And if you manage a fleet, so if you have a bunch of trucks and there's a card that you use to get paid, there are all sorts of problems with the existing solutions, theft and other issues. So we backed a company called Vouch that's solving a bunch of these problems with a new solution, and we're pretty excited about it.
Excellent. And let's go back on the East Coast. I'll actually have Chris Lavery go since he's already unmuted.
No, sorry about that. Well, I'm not an investor. I think Thomas and I probably will share the same experience that being in the crypto world, the digital asset world, every day is pretty exciting. Whether it be, from a regulatory front, whether, it's Elon Musk touting, Bitcoin or Dogecoin. So every day is a roller coaster. So, it's pretty exciting. There's a lot of interesting things happening in this space, especially in the DeFi space. So, I think that's my best sort of overview.
Excellent. Thank you. Thomas, you're up next.
Yeah, I'll pick right up where he left off. So we're pretty heavy into the DeFi space. And I think actually the term autonomous finance doesn't get thrown around enough in the crypto space. But I think, to Trevor's point, that's a really good kind of way to summarize it. And we actually have a couple of portfolio companies we recently invested into. So Fractal is one. They drive liquidity to various decentralized protocols and help people essentially, steer their capital into the most efficient market. And then similarly, Idle does something similar on the consumer side. So Idle crypto assets, they will essentially place them in different lending protocols for the highest return, letting you, sit back and hopefully collect your return and then concentrate on other higher value things.
I actually have a follow-up question to that. So how did you see the whole sector change in the last 5 years? I mean, crypto is still so new to a lot of us. So would love to know a little bit like how you see the sector change and where do you see it go?
Yeah, I mean, I think the biggest shift is, at least in my view, if you looked 5 years ago, probably the biggest fintech plays and kind of the momentum was primarily on creating a better user interface or user experience on a traditional banking system. Whereas, fast forward 5 years to today, now we're rebuilding the actual banking system, so the actual infrastructure. And, at the surface and kind of day to day, it doesn't make a massive difference yet because so much stuff is still being built. We're still early, but I think the difference between those two things of, the neobank with a nice interface on a traditional brick and mortar bank compared to what we have today, which is 24/7 markets, open liquidity, permissionless protocols, et cetera, is, I mean, they're completely different worlds. And we're just kind of waiting for those worlds to collide more and more, I think.
Gotcha. I would love for the other panelists to chime in a little bit on where they've seen not just the crypto market, but the fintech market, like the change in the last 5 years and also where you guys see it's heading. So if any one of the panelists would like to join in, please do so.
Yeah, it's been quite a ride. As Kat and I have been sort of part of this for the past many years, and we've seen it grow like crazy. In fintech in general, I'd say 4 or 5 years ago, I knew every fintech company that raised money, like I had seen the company. And today it's just a very different world. It's grown like crazy. People who've never invested in fintech before have fintech investor in their bios on Twitter. I think the next decade is going to be even better. I'm really bullish on the future of fintech. And I think like a lot of the infrastructure investments that we're making today and have made in the past few years will just continue to pay dividends. It's gotten so much easier to start a fintech company that a lot more will be created. And I think that's ultimately really good for consumers.
Yeah, off what Sheel's saying, just even watching the last decade, back in 2011, we saw every deal in the space and there was like 150, and now we'll see about 1,000. And this is just in the US and things that are in our general interest area and our stage. So it's grown, and we've watched so many more investors come into the space, so much more money come to the space. We've watched valuations. I mean, way back in the day, you could put lead a Series A with $3 million check and get 20% ownership. It's clearly not anything like that. I think that's like, it's like a pre-seed round now. So, it's definitely been interesting. And then to watch the sectors, grow. You had the initial, what people I think were calling like financial services, and the initial lenders, like the lending clubs of the world. And then now you see like lending 2.0 and the buy now, pay later. And like, if you look at other lenders, they've gotten pretty much decimated. And then you're seeing like 90x multiples for these buy now, pay later companies. So it's interesting, like what will be like lending 3.0. Back in the day, insurance wasn't even we never saw new insurance deals like ever. And then in 2015, that started picking up, and now there's all this insurance and there's all this insurance infrastructure. And, it'll remain to be seen if like all the unbundling we do like, or had done in the last 5 years, if like we start rebundling things and embedded fintech becomes a thing, which I know it's really a hot topic, but we shall see if people start cross-selling and bundling again. I'm a bit skeptical, but we'll see. So it's like Sheel said, it's been a wild ride, and I anticipate it to continue and actually just grow even bigger. Like financial services was always, about 10% of the GDP. So it was a very large market. And now we have the infrastructure, and you can build all sorts of applications off of it. And I think you're going to see the same thing in crypto. One of the reasons we had trouble in the beginning seeing how that there weren't that many use cases, and until you built a great infrastructure where you could do a lot of transactions per second, it just wasn't going to be as functional. And now that you're watching that infrastructure be built out, you're going to have all these great front end applications. So I'm excited. And the thing that makes me less nervous about the high valuations, though I'm still not thrilled about that, is that you've seen exits like they've never been before, right? Like there used to not be even $1 billion fintech company. Now there's multiple $1 billion companies, there's multiple tens of billions of dollars, and you're watching them hit like $100 billion. And so that money's going to get recycled back. So sometimes I'm reminiscent for the old days, but I'm excited about the future too.
I like Kat and Sheel, you both said a couple interesting things that have, especially in insurtech, been really powerful, right? I think you mentioned like new infrastructure making it easier than ever to start fintech companies. And I think the increased capital markets interest have really converged to enable just more ambitious visions in a lot of ways. And I think people are taking on more and more ambitious challenges. So I remember, you mentioned like 2015, 2016, insurtech started becoming a thing. I prior to Vouch was at SVB Capital doing like Series B stage investments into like fintech, digital health. At the time, I remember we invested in Bill.com, which I'll come back to in a minute, but that's, business process enablement basically, right? And making payments more efficient for businesses. But we were also starting to host our first quarterly insurtech dinners. And I remember the first one was called Insurance Technology, because didn't know insurtech was a thing yet. And then the next quarter was insurtech. But I remember it was the first or second one we did, and there were about 20 founders, investors, and like corporates in the room. And we had this debate around, innovating at the distribution layer versus taking a more full stack approach. And it was basically, I remember it was like 2 of us that were arguing for kind of the full stack approach versus the other 18 people arguing for like innovating at the distribution layer. And it was basically me and this guy, Alex Tim, who went on to build a company called Root Insurance, which went public last year. And I think if you were to go survey that room today, the mix has shifted, right? I think some of the businesses that were in that room have since pivoted to take on more of a full stack approach. And I think that's only possible because we've got the technology that we can build on top of. So now fast forward 5 years, like we use Bill.com, and like 40% of our customers use Bill.com to pay us on ACH. And that's what enables us to build that, plus increased capital market interest, the evolution from folks like Munich Re, Score, reinsurers that are getting more and more aggressive in this space, enables us to go after a full stack approach that I think 5-10 years ago wouldn't have been possible.
Yeah, I think some of even the infrastructure companies that got built, we had companies that were doing direct to consumer, and then they realized, oh, there's no infrastructure for this, and then they built it, and then they're like, wait, we can enable all these other people. Let's like get away from B2C and we'll do B2B stuff, and they've been really successful. And then now you're seeing, people building on top of it. So it's a virtuous cycle.
I mean, the most extreme example is Brex, right? They were building VR, and then
yeah.
Kat, I'm really fascinated by the point you touched on regarding rebundling or unbundling. This sort of tickles me a little bit, because if you go back, we started with the premise that the big banks were too conflicted, cumbersome, disincentivized, whatever, to innovate around consumer financial services. So then fintech sort of emerges a series of specialist unbundling platforms. And now it kind of seems like, as they realize that it's kind of hard, it's a little bit difficult to turn a profit, whether it's, because of the rails around ACH or limited access to charters. And it's kind of become a game where now every fintech is kind of just becoming like a bank, right? You start off with a brokerage account, and now here's, a prepaid card, and here's like some lending products. And what kind of happens to, I mean, from the money perspective, when someone walks in the door and they've got a very niche product offering, like, does that excite you, or is that a little bit of a turn off?
I mean, depending on what niche it is, if it's something that I'm like, oh, there's a really interesting hook, then yes, realizing that they'll probably build and build into something interesting. But I'm just looking at our own portfolio, how many of our companies have either bought banks or have become banks. And I think, some had to do with, and you're going to know this better than any of us, just the regulatory environment, and that there was some type of appetite for that. I think it will remain to be seen if that is that trend to shift from doing these like very one-off things into becoming a big bank and becoming full service works well. I think there's a lot of benefits to it. And I think a lot of these people that are becoming banks are serving customers, really low and moderate income or middle income customers that the banks really didn't want as customers anyways. So I think you can become the new Chaser Goldman Sachs, but for like an LMI customer. So I think there is a lot of opportunity, but we'll see how people feel when they're really a bank and have all the obligations of a bank. Because if you remember, one of the advantages that these startups had, and Goldman Sachs had come out with that like great report about shadow banking, is that they didn't have the same regulations and they didn't have the same capital requirements. And so it was easier to go faster and to be able to do certain things that a regular bank couldn't. And now they're bringing those obligations back on. So, I mean, I think it's new days that you have these fintechs becoming like large banks. And so it'll be interesting to see where the, what the benefits end up being and where there's, some downside.
Do you guys actually, or better said, like, what do you guys believe are the biggest regulatory issues that we're facing right now? I'm sure like Trevor can like sing a song about this one, but I would love to hear all the panelists to chime in a little bit on that.
I think we should let Trevor start.
Yeah.
I won't sing for the benefit of all of you on this call, but I like this question because I think the way it's often interpreted is in terms of cost of regulatory compliance, right? So what regulations the fintechs have to comply with, how difficult is it, how much time does it take? But the truth is, when you leverage technology to the full extent possible, and there is, let's say, thoughtful integration of compliance obligations with your business processes, compliance eventually just becomes an operational cost, and you can improve as you scale. I think the much more interesting way to think about this question is, what are the ways in which regulation presents an artificial ceiling on fintech growth? And in that respect, the number one reason has to be access to payment rails and bank charters, right? Because the unit economics of fintech companies are really tricky as long as you have to go through a bank to get access to the ACH network or deposit taking. Because what starts to happen is that, I mean, only the very large fintechs can make a lot of money with that business model. If you look at the UK, TransferWise has direct access to the Bank of England, but you cannot do that with the Fed, right? I mean, PayPal still, I think they do all the ACH through Wells Fargo. So, I mean, unless some middleware company can come and somehow disrupt the pricing model, or we innovate around charters, I think that's kind of that. I think that would unlock a lot of fintechs in terms of growth potential.
I've seen a lot of change. You know, my first fintech startup, I see Ratika's on here, was a company called GoPayGo that JP Morgan invested in, which was a mobile payment and point of sale service, right? And people at the time, you know, we were experiencing, you know, dealing with money transmitter licenses and, you know, the usual kind of traditional stuff. And then, you know, also dealing with, you know, unit economics. We were talking about this before, you know, how challenging, you know, just credit card fees can be and how big of an impact it is on your unit economics. And then I joined, you know, blockchain.com. It's a pretty well-known crypto company in this space with a good name. They just raised a $30 million Series A, you know, led by Jeremy Liu at Lightspeed, and Sir Richard Branson invested in it. And we have $30 million. I couldn't find, we had offices in the US, employees in the US and UK, and I couldn't find banks. I couldn't bank. The money was sitting in Luxembourg and I couldn't get a bank account in either country. Therefore, we couldn't pay employees. So, you know, at the time, you know, I was getting paid like 75 Bitcoin a month. So we paid everyone in Bitcoin. And, you know, I thought I crushed it when I got married and I sold my Bitcoin at like 600. And so, you know, one of the challenges that was first in the crypto space was getting banking. You know, the first one to bank us was actually Silicon Valley Bank. And then, you know, our biggest, you know, daily concern was, are the regulators going to come after us? You know, are they going to shut us down? Is, you know, crypto going to have to move out of the US? And obviously that has evolved over time, where it's more adopted, even though the regulatory environment is very uncertain. You know, a good example is, you know, one of my friends, she became the deputy over the DFS here in New York, and she invited me over, and she's like, Chris, can you come over and explain to me how, you know, crypto works and digital assets? Because she wasn't familiar. She's since left, and, you know, she's now in private practice, and a majority of her clients are, you know, digital asset clients. So, you know, I've seen a revolution in sort of how compliance and regulatory environment plays in fintech. It is, you know, in our space, and I believe Thomas will agree with me, in our space, there's just so much uncertainty because there's so many entities that, you know, have a different opinion of what you're doing is. The IRS has an opinion, CFTC has an opinion, the Treasury Department has an opinion, each state has an opinion. So, you know, I mean, the money service businesses, that's true of all fintech. So it's an evolving space, and it's an exciting space, but the regulatory environment is very challenging, just trying to figure out if you're even compliant or not.
Yeah, and just to chime in there too, I think, you know, payments is obviously one section of the fintech landscape, and one area we often run into as well, and in addition to what Chris mentioned, is just securitization, right? So if you have a financial asset, a digital asset that represents something in the real world, but it's sitting, and there's layers of complication. It's sitting on chain, so maybe you as a company don't specifically have control over it. You've written the code that, you know, basically controls that asset. Then where does the liability lie? I mean, there's tons of nuance that has yet to be sorted out, to Chris's point. And I think, you know, securitization is not the sexiest part of the landscape, but it's, as soon as some of that gets, you know, figured out and it becomes much more clear for companies, being able to move a ton of real world assets on chain is gonna unleash a ton of value. And we're just kind of, you know, waiting to see all that shake out.
Wow, I mean, so much happening these days. It's insane. Talk a little bit about COVID-19 and the pandemic, and do you guys believe this whole environment accelerated fintech and crypto as well? Would love to know your 2 words on that, Thomas. and then we can go through the rest.
Yeah, I mean, for specifically the crypto space, I don't know if COVID had a huge impact on it, in the sense that I think the biggest impact I've at least anecdotally heard about is through, is digital payments, right? Everybody being more or less forced to take out their phone and do contactless. So I think that's kind of like a directional step towards crypto, but it wasn't obviously a direct impact, since everybody's using Google or Apple Pay or whatever other option they have. That being said, I think some awareness has been raised as a result. Again, not necessarily COVID related, but like the recent stuff with Robinhood and Gamestop. Lots of complaints about, being Robinhood putting the halt on selling their shares, and with a permissionless market that's open 24/7, that's kind of driven a little bit of adoption of crypto. But again, I haven't seen like a direct correlation between COVID and crypto in that sense. I don't know if Chris has other comments, or if others have seen things that they call out.
I'm not sure if it's causation or correlation, but during COVID, the price increase in the overall crypto market has increased. I can't explain why prices go up or goes down in this space, but what price increase does bring is attention to the space, and so you always will see a lot more people become interested. Institutional people as well as retail people. They enter the space, and there's inadvertently, there's a price decrease and people exit, but it's almost, crypto to me, it's almost a step function, not only in terms of price, but in terms of users, where you peak and then you drop, but you set a new plateau. That's what I've seen the biggest impact during COVID. But, again, I don't know if it's causation or correlation.
Yeah, I was thinking that it was because so many people were sitting at home, and you have retail investors that are trading more than ever because either they're bored, they want something to do, some type of excitement, and they have more time to like read and research. So I think that drove up a lot of trading volumes, and not just in crypto, just across the board. And I think people like Robinhood were big winners there. I also think just even some of the stimulus payments, I watched people invest those. I was surprised how much people either threw it into savings or investing and didn't spend it. If they spent it, it was to like pay down debt for the most part from studies I've seen. So I think even having that little extra money to play with got people interested. But across fintech as a whole, I mean, well, 2020 was just a surprising year for everybody. But if you asked us in March or April, we would have said, oh, I mean, we scared our companies and said, hey, you should have 24 months of runway. We're not sure what's going to happen. We're not sure if capital is going to dry up. And like we went really like, let's be cautious and prudent. And then, within a month that tune changed to, oh my God, we have so much opportunity. Like let's put for most of our companies, let's put our foot on the pedal and go as quickly as possible. And the majority of our companies, and I think like all fintech companies, minus a few that were in unlucky niches like SMB lending, the majority of them ended up going so much faster than they had ever expected in 2020. And then capital ended up flooding the market because there was so much momentum. And then you saw valuations go up 20 to 30%. So it was definitely not at all what we had anticipated. And I think a lot of it is because payments, people started doing more things online. So that helped the payments market. In insurance, you had more people sometimes get nervous to buy insurance online. It's gotten better, like since Obamacare had happened, and some people were getting a little bit more comfortable, but COVID accelerated it by like years and years, and it was everything. It was life insurance. I think people were a little bit more nervous because they understood the uncertainty, whether it was life or health or even auto insurance. We watch people go in, and I was like, why would people be like comparison shopping auto insurance? No one's even driving. Like, I don't get this. But I think people have more time on their hands. They were looking to cut some costs out of their lives, and they had time, and they searched, and they were more nervous, and they understood like all this uncertainty is in the air, and they started buying insurance left and right. It didn't matter what the sector was. So, it was great for insurance. It was great for our payments companies. It was actually great for a decent amount of our lenders. We were shocked. We thought defaults were going to go up, but then we had not anticipated all this money was going to come into the market and people were going to start paying off their debt. So like then you had the default rates low, you know, for our health insurers, they did even better because people were too scared to go to the doctor, so they didn't have those costs. Like it was amazing across the board. All these things happened to, I think, really accelerate a lot. And I think a lot of the trends are here to stay. Once people get used to doing something once or twice online, they feel more comfortable. So I think that will stay. I hope the trend of people being a little bit, you know, more prudent in their financial lives and saving more and having less debt, I hope that stays. I'm a little more skeptical on that one, but I don't know. I think COVID in general was awesome for our industry.
Sheel, it seems like you have something to say about that too.
No, I just like, I'm nodding in full agreement with Kat. Like everything she said is like pretty much exactly what I would say. It's been basically much better than we expected. It's funny, like we sent a letter to our LPs with what we expected the world to be like in April, the first week of April. And we were just so wrong in every way. we thought valuations would come down. We were actually fundraising for our fund, so we thought like we'd really struggle to fundraise. We were making contingency plans for a smaller fund. Valuations would come down, defaults would rise. All these things that we projected were just, every single one of them were wrong. And yeah, like what Kat said, spot on.
Yeah, there were, Kat, to your point on people were more interested in insurance than ever before. That's exactly what we saw at the business level too. You go back to March, there was like a 30%, hit to top of funnel demand. Just people were trying to figure out what the heck was going on, right? But then April, it was like counterparties, VCs cared more about auditing D&O in their portfolio than ever before. We saw a flip in the percentage of companies that were coming to us without insurance or with insurance looking to switch. Inverse than April. And that's like just remained true. I think more people like understand that or think about how that edge case, that like 99th percentile kind of risk can derail their business as a result. But the other, and we talked about like how companies have pivoted. I've seen some really cool examples where like we probably 2 or 3 times a week have companies reach out and say, hey, we moved all of our stuff to storage. Can you like flip our insurance policy over to cover the storage unit? And then I remember a few months ago, one of our clients' neighbor who does like Airbnb, like use your garage to make it like Airbnb for storage, basically, right? They rolled out a commercial product to satisfy the demand for those companies that were getting rid of their office furniture. And so it was really cool to see these companies like pivot and react to the moment. What's been just really surprising for me is over the summer, we saw this huge backlog at departments of insurance and with reinsurers, right? So think about the regulators and the reinsurers and how that impacts their business. Like one, they've got to respond to COVID refunds, all these lawsuits in market, et cetera. So you saw this huge backlog for insurance approvals, et cetera, at departments of insurance. I've been shocked how quickly they've worked through that. I think by like Q3, Q4, we started seeing like things were kind of back to normal. But then on the reinsurance side, and I'd imagine this is true for a lot of banks as well, their books are getting hit really hard, right? They're on the hook for a lot of these BI litigation suits. You're seeing D&O rates from legacy carriers go up 30% across the board right now. And that's just in reaction to a lot of the kind of macro things that we're seeing. And so, I think it's made it that much, harder to kind of build those relationships in COVID over Zoom. But it's just part of the moment in time we're in. These reinsurance markets work in cycles, and I don't know if folks are talking enough about how this hardening insurance market is going to impact the insurtech landscape.
Trevor, what have you been seeing?
Yeah, I mean, aggressive agreement all around. I mean, I think fintech has really just had, let's call it a customer action handicap in the last 10 months. Right, people are home, banks aren't open, so you slowly start getting comfortable with doing things online, just as Kat said. I mean, I'd be interested to see how many new checking accounts Citi opened in the last 8 months, right? And then just quickly on a couple of people mentioned the causation versus correlation. For my statistics nerds on the conference call, there is an answer, and it's causation. So I read this the other day, there's a 0.95 correlation coefficient between Tesla stock and Bitcoin stock. So they've pretty much moved in lockstep for the last 7 months. So, I think there's an answer.
I mean, the whole Tesla slash PayPal embracing of crypto is a super interesting topic as well. We're gonna get more into that in the breakout rooms. I would love to hear like a little bit about like the panel's opinion on the latest Robinhood GameStop saga. I mean, obviously this has been like a big topic over the last couple of weeks, and like what like the risk of Wall Street being the demo. Oh, this is the language barrier here.
The democratization of Wall Street.
Thank you. There we go.
Yeah.
But yeah, we'd love to know a little bit more about that. If you guys want to chime in.
Well, I think
there's
the
go ahead,
DeFi guys. Oh, I was gonna say, sure, you can take it. Otherwise, this is where I'd be screaming like DeFi for life if I was Chris or Thomas.
From my side, I'd say like there's so many components going into this one. GameStop, a particularly interesting one, just given that there's a sort of low market cap stock that had a ton of short interest. And I think it'll be hard to recreate something like GameStop again. But what is interesting is all this interest in Wall Street bets and retail investing as a whole is here to stay. I think that, there were a lot of people who had never invested in stocks before who've got into it. And I'm hearing like my friends who I'd never heard about investing before, like friends in like totally different industries, talking about Robinhood. One thing that I think a lot of people miss is people thought this was bad for Robinhood. Like Robinhood, had these people thought that there were all these conspiracy theories, all this stuff. It was bad for Robinhood. It couldn't be more wrong. Look at the App Store today. Robinhood is still the #1 app in the App Store. They're gaining an insane number of users every single day. I have some inside information. Basically, like the day that this conspiracy theory got crazy, Robinhood gained 700,000 accounts and lost 10,000. So like all of Twitter was ablaze about how it was so bad for Robinhood, how they screwed everything up, and they couldn't be more wrong. So it's an exciting time for retail investing. I don't know if it's good for consumers at the end of the day. That's something I struggle with. Kat, you probably have thoughts there. But to some extent, it's like legalized gambling, and but the odds are kind of more in your favor. So I think a lot of people are seeing it as that.
I share that sentiment. I'm not sure if it's good or bad for the retail investor. From a finance perspective, discounted cash flow, you're like, yeah, of course that stock should be going down. But in terms of, on a regulatory front, I got a debate with a friend of mine who's a banker, and it's like, that's, illegal fraud, blah, blah, blah. And I was like, I'm not sure if that's correct or not. That applies to retail investors. Like, you work for a bank, you're licensed, like you can't do that. But can I get together with a group of my friends and decide that we want to talk a lot about some stock? I've seen some discussion on that. One of the more interesting things is, I joined just recently Clubhouse. My wife is really into it. And the only one I really listened to was the CEO Robinhood was on it. And he actually made a very interesting point that, we don't regulate people when they spend, $2,000 buying a TV or some purchase. So, why are we regulating someone buying $2,000 worth of stock or something? So, this gets to the democratization of finance that, how do you balance, trying to protect the retail investor? At the same time, how are you democratizing the system? So I in my head, these are all the various things that what Sheel touched on as well, that I think GameStop brought to the forefront.
Yeah, and the other element, I agree that whether or not it's market manipulation, and I know the SEC was looking at Wall Street bets, and apparently they're in there, haunting the halls nowadays, watching all the chats happening. But regardless of the outcome of that, I think one huge benefit for retail investors is just the amount of education and really understanding the nuance of these markets. I have a friend in like nonprofit public administration who wanted to understand how, basically the mechanics of the entire process, like how does a short works? Why were they getting squeezed? Robinhood shutting down their trading activity and why that was. So you get this big increase in education that I think these events just drive, and it's hard to recreate that in a traditional way, which is, those traditional ways are much more boring when you say, hey, come invest and earn 6% on your savings account.
I think people will be okay if they can earn 6% on the savings account. I think that's the problem, and one of the reasons people are going to some of these investments. But hopefully, what will happen is that they'll start teaching this in schools earlier and earlier, and just like how coding became popular and then they brought it to elementary schools and middle schools. I hope they start doing some courses about investing. I think what worries me is a lot of people just have no idea what they're getting into, and it could be more transparent. And you see in lending, there's a lot of transparency laws, and even with those, like, people don't quite know what they're getting into. So I like to see people do more on transparency. And in the end, we tend to believe not to be paternalistic, and people are adults and they should have responsibilities and be held accountable, and can choose if they want to risk their money, just like how they can walk into a casino, right? It might not be my choice, but people have that choice. But they should be properly, at least there should be transparency. So maybe there's a button like, you might lose all your money, just like what it should say before you go into a casino, or just like on a pack of cigarettes that warns you this is not good for you. I think as long as there's full transparency, then I think you're gonna have to let something like this happen.
Yeah, and tack onto that really quick, I completely agree, especially when you get, it's one thing to buy $2,000 worth of stock when you're talking about options and leverage and derivatives and things that people, it's just difficult to understand as a first-time retail investor, and you can all of a sudden lose much more money than you even have. So yeah, just doubling down on that point.
Yeah, well, and who knows how it'll shake out, but I think one thing's for sure is there will absolutely be, litigation coming out of this. I think it'll be really good for class action attorneys and really bad for insurance companies that, have a duty to defend that. But I think it, longer term, there's back to Trevor's comment around correlation and causation. There is an incredibly high correlation between democracy and litigation. And, if you're either using authority to mandate rules, or in a democracy, you use litigation to hold people to account. And so I think as we see increased democratization in fintech and Wall Street, et cetera, like, we're also going to see, increased use of litigation. And I also think, for companies like Robinhood, that's a distraction that you have to be mindful of, right? Both from a cash and kind of time perspective from your leadership team. And so, I think it's a delicate balance of how much risk you take to take on that, kind of litigation risk as you grow.
Travis, I think that's a good public service announcement. And for all the entrepreneurs that are on this call, make sure you have D&O insurance, and make sure that you have enough D&O insurance. And like, you don't want to be penny wise and pound foolish, but even in our earlier stage startups, we've seen more lawsuits than we've ever seen before. So yeah, just make sure you consult your friendly faces at Burkland, and make sure you also have enough D&O.
Thanks, Kat. That was an unpaid endorsement. Thank you, everybody.
Yeah, does anyone know anywhere where they can get D&O insurance?
I know Mark has some of the bigger companies, and they'll do some crypto companies that no one else will underwrite. So toward this problem, actually, what Travis had pointed out with all these lawsuits, a lot of people, especially if you're based in California, again, this is a good announcement. Come to Florida, where I am, but and where Ruben is right now. But a lot of the D&O insurers aren't insuring California startups anymore. These are just too expensive, and like, the premiums just don't make sense for people because it's that high. There are some people that will do it, but if anyone pings us, we go through a broker that will go through a lot of these D&O. And like I said, Marsh and McLennan, especially for the crypto companies we know, they've been good about doing more creative things.
It's funny you mentioned crypto insurance. I was on a group Slack channel, and they were talking about D&O insurance, which I agree you should have, and people were surprised at how much it's increased, and they're like, this is what my yearly premium is, and I was like, that's my monthly cost for crypto insurance, so you should be happy with that. It's very hard to, as Travis probably knows, it's very hard to get people in the digital asset space insurance.
Yeah, and it comes back to this conversation around reinsurance and regulatory appetite, ultimately. For instance, we cover companies that are, blockchain companies, crypto adjacent, but if you have an actual, token or you take custody, that's a higher bar for reinsurers and regulators. And so that's where, you oftentimes have to work with London to craft kind of custom programs. And I've seen a lot of companies, really well-funded companies, choose to self-insure just because the premiums are, you're talking 500K a year, plus for a lot of times. So, some companies are choosing to self-insure, but I think there's some really interesting tooling coming about that will help get reinsurers and regulators more comfortable with some of those risks. You need like real compliance tooling to, I think, understand those risks and kind of parse the good from the bad.
And just maybe one point back on the Robinhood thing. So the House Financial Services Committee is holding a hearing later this month to look into the GameStop thing, and they've got Vlad coming in. But I think it's worth remembering that from a regulatory perspective, in many respects, the system worked, right? So broker-dealers have to contend with capital requirements and margin rules and liquidity. And there are legitimate reasons to restrict trading, particularly in that sort of 2-day lag between execution and settlements, an SEC requirement. So on one hand, there's kind of this democratization, reducing the barriers to sophistication, retail investors, and everyone's outraged. And then on the other hand, regulators are sort of going, well, like, in a sense, the system worked, right? When shit got crazy, they stopped trading. So it'd be interesting to see kind of what the outcome of, some of these SEC Wall Street bets trolling is. Yeah.
Great. A question that given the discussion that we just had, really just wanted to know, where do you guys see the next trend for 2021? What are the big things that you guys think are going to come out of this? Would love to know a little bit more about that. And I think then it's almost time for the breakout rooms where we can dive into a little bit more particular questions on each sector.
Well, Sheel sent his LPs a good prediction letter last March, so maybe he's got a 2021 one as well.
I think we'll continue to see a lot of interest in the sector. I think there's just going to be so many exits coming up that I think the interest in fintech is never going to be higher than it is, or higher than it ever was before in the past. In terms of specific sectors, I don't have any. I think we're still pretty excited about some of this infrastructure. There's still some interesting companies that we're seeing. I don't think that there's a single hot area that people are talking about the way that infrastructure was last year. We've seen a lot in FP&A for whatever reason recently, but I don't have any particular great predictions for you, unfortunately, other than the sector is just going to continue to perform super well.
Yeah, and I agree with Sheel, and I just say though, I do think people are going to focus more on the middle market and the low and moderate income consumer. I think a lot of people are just seeing what happened at the Capitol on January 6th. And if it hadn't hit them before, it really is hitting home. And unless, and not to be extreme, but unless you want to end up in some kind of civil war, we're going to have to do something to fix the problems that are facing the country. And I think entrepreneurs are awesome at fixing really hard challenges. So we've seen more people go down market than ever before. And so I'm looking forward to that. I think, one of the things when I watch all these crazy valuations, a CEO of mine that had been at Bridgewater said something that really resonated with me. And he said, Kat, don't think about the companies being really high, highly valued. Think of them more as, it's a hedge against a weak dollar. And so I think the valuations we're seeing are as high is because our dollar is probably a lot weaker than what maybe some of the inflation is showing. And we're throwing more money into the system. And, so that's what I'm thinking about some of these companies, and that made sense to me and how I can justify some of these higher valuations. And just thinking like, if you have them and you didn't think the dollar was as strong, that's kind of really what the company valuation is, because we are paying in US dollars. So anyways, I'm excited to watch some entrepreneurs tackle some real world challenges.
Awesome. Anybody else that wants to chime in? Otherwise, there's a couple of questions in the chat that we can go to. Anyone on the last question?
One interesting point, touching on Kat's point, is, agree on the US dollar point, and then being a bit myopic, of course, focused on crypto. One of the big kind of explosive areas is also not super sexy compared to the price of Bitcoin, but it's stable coins, which are typically just crypto that's pegged to the US dollar, and whether that's algorithmic or some other mechanism. But those, they're unleashing a lot of different use cases, basically going back to the bankless idea of, how many elements of the financial services system can you do with crypto without needing a third party. And it'll be interesting to kind of see how the weak dollar and crypto being very closely tied to that continues to interact. But I think it'll be, regardless of what happens, it's going to be very big in 2021 for those of us involved.
Yeah, I just would kind of sound the alarm on unintended consequences, right? Like, I think we a lot of the things that Kat talked about in terms of societal issues. I mean, let's go back a few years and talk about the impact of social media on society, right? And how we've seen the unintended consequences play out there. We just talked about Robinhood and GameStop and kind of the unintended consequences of democratizing, investing. Those are all great innovations, but we've got to think about the side effects as well. And I think about, we're providing liquidity to private markets. Well, how is that going to change behavior at the company, at the operator level? And what is that, how does that influence outcomes long-term? And so as the rate of kind of innovation in this category accelerates, I think so will the volatility, and so will some of the unintended consequences. And that's okay. That's part of the innovation cycle, but we just have to be, I think, prepared to, and create the robust mechanisms to, respond to that and help kind of dampen the impact.
Agreed.
Great. So there's 2 questions in the chat, and 3 now. So the first question is, how likely do you think companies of Alipay comps of Alipay will become a thing in the US or other markets? Anybody on that?
I think there's probably is not an opportunity. Like, I think a comp to Alipay is really complicated in the US because we have so much different infrastructure that there's no perfect comp. Like, you could comp it to Visa to a certain extent. So I don't know. I think probably a better comp would be like Square Cash. I think that there's a tremendous opportunity in some other markets for a comp. We're investors in a company called Chipper in Africa that is, I think, the closest comp, where people use it for P2P transactions, people use it to pay merchants, et cetera. But I think there's a large opportunity. I just don't think the US is probably the place where this is going to happen immediately, just because we have such a good infrastructure with credit cards.
All right. Thanks for that, Sheel. Next question from Jim. Given Musk's endorsement of crypto, what is the 5-year lookout for integration of crypto and that fiat fintech infrastructures? I think this is something more for Thomas, maybe Trevor, as well as, I'll let you guys decide who wants to speak first.
I mean, yeah, I'll jump in. I'm actually really curious to hear kind of the, quote unquote traditional fintech perspective on this, because obviously, anyone in crypto is overly bullish and constantly screaming about how great it is. So hearing kind of the reality check from others will be really helpful. I think, it goes back to actually what I was mentioning before. I think there's originally, and this is 2017 when we're still earlier in the space, there's a lot of talk about crypto as payments, but then you have the volatility issue, right? So no one wants to get into the 2 pizza scenario, which is the famous scenario of buying pizza with Bitcoin and then being out $80,000 later on. So stablecoins start to help solve some of that, which is what I referenced before, right? It's just a digital dollar, very similar to what you use on Venmo, except it's blockchain based. So I think that's going to start happening. You typically have a pretty heavy barrier to entry though, when you have, you need to get retailers on board, unless you're doing straight peer-to-peer, and that's a very hard network to crack. So I think we still have a little ways to go. There's some online payment providers that are starting to accept crypto. So, third parties that are integrating, et cetera. So it's slow, but it's happening. And again, would love to hear what your experience is.
Yeah, I think Thomas has some good points. The thing is, people can offer, and like you can, let's say when you can buy a Tesla with Bitcoin, you may not, because of what happened when people spent 100 Bitcoin buying a pizza, and you really don't want to do that. And I think a lot of people that are holding or they're selling to make cash, and I don't see people spending it. So it's kind of like it's like a chicken and egg problem. So, okay, but now you have it, but unlike a marketplace, you really need like the demand side. Do people actually want to buy this stuff? And I don't think so until you have a lot less volatility. And I think it was to Trevor's point, right? You have 2 of the most volatile things, Bitcoin and Tesla, highly correlated to each other, and like people are investing on both of them. So, I mean, it's going to be wild. I don't know if it's going to go really well or really badly. We were taking very volatile things that are highly correlated, which isn't great either. But I don't see people, spending Bitcoin for a very long time. And until you start seeing that happen and there's some stability, I mean, why would someone buy it? I mean, why would they use it to pay? So all these people can offer to accept payments in Bitcoin. I think the city of Miami is now going to do that as well, but I don't think people will use it.
I mean, I can speak directly to it as being on sort of the operations side of the crypto space. I mean, I used to, pay employees and contractors, I mentioned, in Bitcoin. I think my monthly salary, if I kept my Bitcoin today, would be $4 million a month. So I learned my lesson on the Bitcoin that, I'm just holding it, right? But what Thomas mentioned, which is a huge change in this space, is the stable coin. And, I pay multiple contractors, partners, millions of dollars, probably on a monthly basis in stable coins. In terms of a payment system, it's very easy to use. The challenge is that, I think the challenge for adoption, the challenge for institutions to come into the space is like the infrastructure. Like the first problem was like, where do I custody this crypto? I don't want to have to keep these private keys. If I lose it, I lose all the money. Now there are multiple great companies that have a custody solution, right? There's no great way to, like even auditors, like I was trying to explain to an auditor multiple times that we're not, creating Bitcoin and it's not stored in our bank account and you can't get a bank statement. I mean, these are just simple things that, normal businesses are used to. We talked about getting D&O insurance. Like it's very hard to get D&O insurance. And then if you want, institutional people to come in and you're not going to insure their investment, then they're not going to come in. So there's really, the digital assets space, there's really two sides. There's the infrastructure side, which, Thomas and I sit on. And then there's other people who've come from, a lot of people from traditional finance who've come in from the speculation side. And we've made a lot of progress on building the infrastructure of the digital asset space. But we have a long ways to go before it be fully adopted. But it's moved faster than I thought. And, originally people thought that Bitcoin was going to be the blockchain. A blockchain is going to do everything. Now we've already discussed it. It's almost just digital gold. No one's using it for the most part as a payment system.
Thank you for that. And a quick reminder, we're about to go into the breakout rooms. So everybody that wants to be on the crypto blockchain breakout room, please raise your hand. Everybody else will most likely be pushed into more of a general fintech breakout room. Does anybody have something else to say about what we just discussed? Otherwise, I think we're about to do the breakout rooms. It would be a good transition for that as well.
Oh, thank you.
Awesome. Okay. So I guess then we'll just start the breakout rooms. JP, who's my colleague and co-host, if you want to start those. I know Kat has to jump off, but Edwin will take over for her. So yeah, let's go into the breakout rooms.
Can someone test and just see if they can join a breakout room? It looks like people are able to join. So if you want to go ahead and just open up and choose a breakout room, that would be great. And anyone who is not, we'll assign you to one.
Thank you, Bree.
Guess we'll give it a second, obviously, to let people creep in.
Exactly.
If it ends up being the four of us, we'll have a very intimate conversation where we can dig into anything.
There you go. Well, this has been great so far. What do you guys think?
This is my first time in a Zoom breakout room.
There we go.
Very good. Thank you, Ruben, for doing this.
So I think I'm just going to pull up the chat again so we can go more into questions. Just so nobody talks over each other. I would say we give it like another minute or two. And otherwise it's just, what is it? 1, 2, 3, 4, 5, 6 of us talking, actually 8.
Hello.
Hey, Chris.
All right. Perfect. So yeah, would love to have a couple of, I'm sure you guys have a couple of questions on like the crypto blockchain side. We have 3 experts here with us that can answer any questions or do a little bit more of a deep dive for you guys. I suggest for you guys to probably write these into the chat so we don't speak over each other for the audience. And then we will have the panelists discuss those questions and go over those.
And while everyone's chatting, thanks for hosting, Ruben. You're making me realize how much I want to interact more with the non-blockchain fintech folks.
I mean, that's what this is there for. Okay, perfect. I think Chris just asked a question. Can you guys see it in terms of Thomas, Trevor?
Yeah, and I can provide some perspective on it. To me, this is like one of the burning issues, having seen 2017 and the rise of the ICO, and then now you have this A16Z backed distributed market maker that does effectively an ICO and now has a $6 billion market cap. And, you know, maybe it's on somebody's docket at the SEC, but, you know, if not, I'm just curious as to what needle that they threaded to make that happen.
Yeah, I'll take a quick stab at it. And I don't know if if others please have more expertise in this area, because I'm by no means an attorney, but I do know after working, we have two general counsel that we work with constantly on these specific issues, and they have a lot of commentary on them. I would say two elements. One is how the distribution happens. So that's a massive one. You have basically a shift recently to when people distribute tokens. The big difference between 2017 and today is usually they're very intentional about distributing it to a large number of people versus a lot of 2017's ICOs were, private sales or pre-sales that happened before the token ever went public. So you had this unfair market of, I'm going to buy it at 10 cents and then it's going to go live on the market next week at 20 cents and I instantly double my money. So, so democratizing the distribution up front, and then also that's like one element, and then there's some other elements that I know of come into play, and none of this is binary, right? It's still being it's multivariate, but point being, you have the distribution element and then you have what it does. So whether or not the token is a governance token or whether or not it represents future cash flows of the company, which makes it look more like a security and obviously starts bumping up against that boundary. Those are two things. And then of course, lockup periods as well. So having the ability for, A16Z in your example may have gotten some of those tokens, but the tokens may be locked up for them for a year so that they can't immediately profit off of retail investors. And that also helps them steer clear of some of the regulatory issues. So again, not a perfect algorithm for sidestepping the SEC, but those are some of the elements. Yeah, please.
Yeah, the challenge in the space is there's no bright line to anything. So, Thomas was talking about, right, the SEC securities law, which is, it's very gray and it's evolving, and there's that timeline. Thomas was right on the things he addressed, but even the expert securities lawyers aren't sure on this, right? They're all kind of reading the tea leaves. Trevor may know better than anyone. Gary Ginsberg's coming in. People aren't sure how he's going to react. He understands it. He taught this at MIT. He tends to be this is personality. He tends to be someone, when he cares about something, he cares about it a lot and gets very hands-on. So he'll roll up his sleeves and get into the details of securities regulations for crypto and try to bring clarity around it, even though the clarity may not be great, but there will be more clarity. And then you have FinCEN, which, FinCEN has the attitude like, I don't care if you're centralized or decentralized, you have to KYC, AML, everything, right? And so it's very hard. And then, if you take a fee, as soon as you take a fee, then that changes it. And, now you have money service business. Sure. So, it's very difficult to try to keep up with what is proper in this space. What you could do is you could do the best thing that you could possibly do based on the current thinking from, some of the best attorneys.
I thought it was interesting. I've set up effectively one of the first neobanks in the country. But one of the things I thought about, like, this was, it was actually set up as a commodity from the beginning. And if you sort of apply the Howey test to it, like the proceeds didn't go back to the company. They went to the various market makers. A16Z, I think, was a market maker. They just I think that's where a predominant amount of their investment funds went towards. And then they might have had to lock up and a number of other things. So, and then the product was already built and operating. And if you notice, if you go to their website, it's set up as a .org. So I think it's either a foundation and they've open sourced the software, so they don't even get a benefit from the resale of that. I mean, I think there's a market maker fee that the central entity might get, but that had nothing to do with the ICO other than that they pay people in their unique tokens. So, and I do think, if you look at like Bitcoin or even maybe Ethereum versus like a Ripple, that centralization I think is a big element of how it might get regulated, where it might get regulated. So SEC versus CFTC, and the proceeds didn't go back to any type of common shareholders, even though the shareholders of the Uniswap entity also were market makers. I don't know if that, and someone did say that they did and I'm not too familiar with it, but like a Reg S, so it was like an offshore filing, and then and most of the token holders were not in non-custodial wallets.
Yep. And you did touch on one element, which is lots of teams are setting up this dual corporate structure of having a foundation or a nonprofit BV kind of holder and allocator of tokens, and then the for-profit entity is kind of coupled to them running the actual business. And I think to Chris's Chris's point, most people are just trying to stack as many of these up as possible, so that there's like as many barriers to them getting prosecuted. And there's no secret sauce, but try to put as much between you and the SEC as possible.
Yeah.
I mean, I always tell people the best advice, I tell internally companies and other people, the best advice with regulators is being open and honest and having a dialogue with them. Say, we're trying to do this. What do you think of this? They're like, well, I'm not sure. Let me get back to you. Like, okay. As soon as, I worked for, I have one CEO who's, he's like, fuck the regulators. He's like, what are they going to do? He's like, they're not going after Uber, and they're not going after Airbnb. I was like, yeah, they're regulated by the Public Utilities Commission. That's like a civil penalty. We're regulated by, FinCEN. This is criminal penalty. You're talking two different things. I'm not going to jail. I always tell people I'm not going to jail. So you just have to have an open dialogue. There is no blue harbor. Thomas said, great analysis. He's probably right. I don't know if he's right. He's probably right today. He might be wrong next year. And, that's why it's better to have this open dialogue with regulators saying, we're trying to do this. And, here's our current thinking. This is how we think the law applies. What do you think?
Yeah, and this is on sort of the regulatory interaction point of view. This is something that fintechs haven't really gotten around to quite yet. Certainly not in the way that banks have, right? Because they've been regulated by 300 years. This idea of having open dialogue with regulators. FS Vector also has sort of a public advocacy vertical. And we often tell our clients that you don't want to introduce yourself to a regulator the first time they come ask you, what you're doing, right? At that point, it's too late. So, my advice in that sense would be, as you're in the product development phase, before you start offering a product or service, before you have customers, before money or crypto is moving around, ring up the DFS and say, listen, we're starting a business in New York. This is what we're trying to do. What does that walk like to you? And they're open and they'll have these conversations. And I think particularly now, because, you're seeing all this stuff about fintech and valuations, and states are starting to realize that it might be in the best interest to attract some of these businesses. One of our partners just met with the governor of Delaware, and he is in the process of trying to launch this sort of big fintech like welcome thing, kind of the same way Wyoming has. So I think definitely ask them, and regulators have a ton of discretion, right? So as you start launching, you start doing stuff. If it starts to look like it might not be, it might be something that they would regulate. It might call you. We have regulators reach out to clients all the time and say, listen, I'd be careful about this thing that we just saw you kind of publish.
And don't be stingy on your legal budget. Yeah, it's going to be expensive. If you're in fintech, it's going to be expensive.
I've spent $25 million over the past 20 years. So I get it.
Sorry, go ahead, Trevor.
No, I was going to say it is expensive, but the reg affairs lawyers are cheaper than the litigation lawyers. So, pay the guys up front as opposed to fix it once it starts burning down.
Yeah, I tell people to kind of view it as insurance. I mean, just view it on, you're basically paying insurance that the whole business you built up doesn't come crumbling down because the regulators think that you did something illegal. So, I pay D&O insurance. I'm hoping never having to use it.
I also think, I think Jim, you had a question if you want to ask it.
Sure. Yeah, I would. So Thomas, I think it was you. Talked a lot about the stable coin, and as those are introduced, there's a lot of interest in that area. I mean, the specific area I'm in is I deal in. Our company deals with the issuance and redemption of digital rewards, right? And so those rewards are 100% backed by U.S. cash. And I wouldn't necessarily refer to that as a stable coin, but as we get more and more into digital assets, that type of thing is going to be more and more interesting. And I'm just curious as to, when does a digital asset become a stable coin, and what's the process of legitimizing that in any given industry? I mean, we're heavily involved now in starting to launch into the mobile video gaming industry. So tons of digital assets, 100% backed by the publishers, by cash, which can then be cashed out. So it's sort of like airline miles, right? I mean, they have a monetary value. It's on the books. Is that a stable coin?
I mean, I wouldn't consider it one, and by no means am I the authority on this, but I think generally stablecoins they're specifically pegged like 1-to-1 from one coin to one USD, which it doesn't, just by your short description, doesn't sound like that's the case for the digital assets you're using in your game. However, I would say it sounds very similar to a number of other coins or digital assets that people are using. I mean, we've invested in a couple of gaming companies that look at specifically deploying, a unique, basically a unique cryptocurrency, or there's a whole different ballgame, but something called NFT, non-fungible tokens, where you can own specific digital assets. And so this includes you own the one skin for your warrior in a game, and no one else in the world can have it unless they buy it from you. So it sounds like it'd be more akin to one of those types of assets, in which case there's a ton of opportunity, right? On one side, if you build out a custom cryptocurrency for your game, you can kind of build out this very efficient economy within all of your gamers. And it's very easy to track all those assets. And then on the flip side, the NFT world is completely different. It's kind of like the art marketplace, right? It's the value of different NFTs is quite subjective, and it's subjective to the market depending on who wants to pay for what.
Yeah, you're really addressing, more. There's both in the gaming industry. There's both those non-consumable assets, the particular skin or the weapon that's being used, but there's also a ton of non-consumable assets, and that's really the issuance of rewards. I mean, rewards can be issued for tournament play, as an example, right? They have a monetary value. How do I redeem those? I'm not suggesting that it has to be a stable coin. I'm just curious as to, I mean, it's certainly similar to a stable coin, and so curious as to, when it gets, put into that genre versus, it's just a reward.
I mean, you can look at it from an accounting perspective, because if you look at from like in crypto accounting, it's evolving as well. But if you look at an accounting perspective, if you have a true stable coin like USDC or Tether, right, you could treat that as like a cash equivalent on your balance sheet. If I hold Bitcoin or anything else as an intangible asset, so if the airline miles, right, they're not worth what they're on the financial statements. They're fractions of a penny, right? I mean, they're not. So to me, a stable coin is I know I could get exactly 1 unit out and get the US dollar equivalent. And even Tether is a stable coin, but it's like 99.8% stable, right? I mean, there's still a risk. There's still a risk to it, right?
Right.
So,
thank you.
I love stable coins. Love them.
I actually have a question for Trevor, if I can chime in here. Be curious, just generally speaking, in the being so embedded into the traditional fintech space, what is this perspective of crypto? Is it the sense that crypto is eventually going to eat our lunch, but it's 20 years away, or is it that's an entirely different world, we don't have to worry about it at all, or these two things are going to integrate eventually and we'll watch it happen? Is there like kind of a general market sentiment in that regard?
Yeah, I mean, I think people probably focus more on the blockchain than crypto, to be frank.
Yeah.
Because, and it's interesting, we asked the question earlier about the future of crypto, and I mean, blockchain has real applications, immediate applications in cross-border and real-time payments, right? I think as far as crypto, it's sort of it's almost a wait and see thing, right? Because as we've all spoken about, in terms of a store of value, volatility kind of cuts straight through that. As adoption increases, does it stabilize a little bit, at which point it becomes more interesting? You'd be crazy to buy anything with the cryptocurrency at the moment. And I think you put that together with just like the general lack of understanding around cryptocurrencies, right? For mostly sort of the protocol companies, I think people will just still continue not to understand why someone creating a coin, issuing a coin, inviting exchanges to trade it. What is it? What's it for? What's the point? What do we do with it? Why do we need it? So I think the level of education is super low on cryptocurrencies generally. Obviously, Bitcoin and Ether have kind of taken a lot of the oxygen in the room.
Yeah. That's helpful. Thanks. I'm just always curious because I know I'm in the echo chamber over here. So
we have.
Sorry, what were you gonna say, Ruben?
Yeah, just to be conscious of the time. We have like 2-3 more minutes, and then we like having our outro. So just be cautious about that. But go ahead, since you guys are having such.
Is there any other question? I was just gonna chime in on that.
No, chime in. Go ahead.
Yeah, I'm always interested. It all depends Trevor, who I speak to, right? If I'm speaking to a bank or someone, I'm talking about blockchain technology, right? But generally speaking, in this space, other degenerates in the space, I call it, crypto. But because it's a token of blockchains, peanut butter and jelly. So there's different blockchain technologies out there, and but it's right. At one point, remember, it was I'm not interested in Bitcoin, but I'm interested in distributed ledger technology. And I was like, okay, so I always find it interesting how people's point of view.
I mean, where would you, if you guys were to put on kind of your predictor hats, where would you see? Well, let's make this even easier. What would you like to become the future of crypto? Less prediction, more like aspiration.
I'm a big fan of the actual democratization element. So there's a huge last mile hurdle and education hurdle, et cetera. But the idea that you can participate in a global marketplace, and you can, if you have some amount of assets, you can lend those out and generate a real interest rate. Whereas as probably everybody knows, there's a huge number of people that are unbanked and don't even have an option to participate in that. So obviously we're a long ways away from those people leapfrogging from unbanked to I participate in crypto lending markets, but being able to close that gap, I mean, that's kind of the vision that I hope for, where we actually democratization in the real sense, not just for people who are already wealthy.
I would agree with that. You know, and this goes back to just our previous comment about the blockchain technology. I mean, it's really, to me, it's just the Internet 3.0. The Internet was all about being able to communicate, and the Internet 3.0, blockchain technology, is about the ability to transact without needing a trusted third party. It basically comes down, it's basically a new accounting system. How do you prove ownership in time? And once you can prove ownership in time, then it opens up all the democratization. You know, I could buy land somewhere if I could prove someone owns it. I don't have to pay a bunch of people to do title searches. I'm able to send money. I don't need third parties validating that I have money to send. So, but it's really, to me, it's just the ability to transact without needing a trusted third party, which to me is Web 0.30. And so that gets back to your blockchain point earlier, that I am interested in the blockchain. I'm less interested in the speculation. Though I do like to make money on it, I'm less interested in it.
The same.
All right, excellent. I think we reached our time limit, so thanks everybody for attending. I think we can go back to the rooms and just making a quick goodbye.
Okay.
Otherwise, whoever wants to jump off can jump off as well. Obviously, connect with our speakers if you guys can. Yeah, thank you for tuning in, and thank you for listening and asking these questions and answering as well, of course.
How do I get back to the...
All right, bye guys.
Bye.
We're back on the main stage. I think the other room is still happening. Let me just ping them. And
it looks like everyone else, it looks like we all rejoined.
It does look like that, doesn't it? Okay. Anyways, yeah, no, this was great. You guys feel free to jump off. I mean, I want to be conscious of your time. Thank you so much for attending. Yeah, this was excellent. Thank you, guys.
Thank you.
Great. Thanks so much, Rube. Thanks, everyone.
Thank you.
This was amazing.
Bye.
Thank you.
Bye.